This is Club. I'm your host, Simon Wunderlich. Let's get right into it with VIC readings, the format where we look at the best of the best value investment recommendations by the best of the best value investors out there. Today we have Constellation Brands STZ, the ticker is. Price at the point of filing is $225. This is not a recommendation, not advice. Please do your own diligence before investing into anything. And let's get right into it. And please write down in the comments below if you have invested, will invest, or why not into Constellation Brands. STZ. Description: Constellation STZ has underperformed recently due to more transitory concerns and is now attractively valued relative to peers. Its historical valuation and its growth rate. The stock was at 260 in early December, but recently traded as low as 208 due to concerns around slowing beer revenue growth and FY23, FY24 beer operating margin pressure. The stock has recently bounced back to 225, but still remains attractively valued. The slowing growth concerns are valid, Modelo more specifically, and worth monitoring, but STZ's valuation now more reflects these concerns as long term versus short term. In addition, the focus on potential slowing growth has lessened the focus on more tangible and positive longer term changes. The two most important being the elimination of SANS controlling share class and STZ's commitment to improved capital allocation, e.g., lower net leverage, no incremental capital to Kenobi W&S divestitures. STZ is trading at 14.7x FY24 EV EBITDA and 13.3x FY25 EV EBITDA. This compares to Staples trading at 14.1x FY2 EV EBITDA. I'm assuming FY24, right? FY2 EV EBITDA and beverages at 16.7x. STZ has been written up in the past on VIC, with the most recent one on April 28, 2022. These write-ups provide a good background of the company and its capital allocation disasters, e.g., Ballast Point, Canopy. Much has changed for the better in the past couple of years, though the stock price has remained flattish at 225 now and in 2018. The Constellation beer portfolio consists of Modelo, Corona, Pacifico, Victoria, and Funky Buddha. Modelo is the largest brand at $4.1 billion retail, or 55% of Constellation's portfolio. Corona is the second largest brand at 3 billion or 40%, and Pacifico is the third largest brand at 290 million or 4%. Modelo remains under-distributed relative to brands like Corona and Budweiser, and this is the long-term growth opportunity for the company. E.g., Modelo dollar velocities are almost 2x that of Corona and Budweiser, but distribution, when measured by number of items, ACV, or total distribution points, TDPs, lags both Corona and Budweiser. The company's two largest brands have experienced decelerating growth in the past couple of months, November and December. It's impossible to pinpoint exactly what has caused the deceleration, but potential reasons include a difficult weather compare in California, 25% of the business, much hotter last year relative to this year, a difficult Omicron lap as beer consumption has shifted to at home a year ago, increasing elasticity due to higher prices and more general macro/trade down weakness. Modelo and Corona are more premium priced. Constellation's beer consumption data shows outsized pressure in California, which suggests weather might be part of the issue, but industry checks also indicate higher pricing has been an issue. Many retailers and distributors took incremental pricing on top of STZ's pricing. This caused the on-shelf price to consumers to move up rapidly and significantly. At a recent beer conference, several distributors/retailers noted rolling back on shelf prices modestly given the outsized impact to STZ's volumes. It's early, but the response has been positive with respect to STZ's beer volumes improving. Historically, STZ has taken plus 1 to 2% pricing per year. Retail pricing in recent weeks has been plus 5 to 6% year over year. As noted above, there are several potential drivers of the recent slowdown, and only time will tell whether it is short or long-term issue. That said, STZ's valuation at 14.7x EV EBITDA seems to reflect these issues as more long-term in nature, so any improvement should drive a re-rating in the shares. In addition to the beer revenue growth concerns, STZ has been dealing with outsized cost inflation similar to peers. Plus DD cost inflation in FY23, the company recently, as of FY3Q, provided disappointing beer margin guidance for FY24. Management said the beer margin should be roughly in line with FY23, so 38%. The primary driver is another year of elevated inflation plus HSD and incremental costs slash depreciation associated tied to beer capacity expansion. Packaging and raw materials are 60% of COGS and still inflationary given buying slash hedging programs. The company's LT beer operating margin target is 39 to 40%. The 5-year average through FY 2022 is 40%. STZ will take longer to rebuild its margin than peers, given its more limited pricing relative to peers. E.g., some staples are realizing low double digits to mid-teens pricing, while STZ has guided pricing this year in the plus 2 to 3% range. In any case, consensus estimates now reflect a 38% beer margin segment in FY23 and FY24, so any improvements toward a 39 to 40% would be upside to estimates. As noted in prior write ups, Constellation's capital allocation track record is poor. Ballast Point and Kenobi are the best examples of the company setting cash on fire. That said, this has been improving in the past couple of years with the divestiture of lower margin, non core wine and spirit W&S brands. The company has also been returning capital to shareholders via repurchases and dividends. In addition, management has publicly stated it will not deploy incremental capital to Canopy. Lastly, and most recently, the company eliminated its Class B common stock, which eliminated the Sands family control of the company. It came at a cost, $1.5 billion to the Sands, but should be a positive move over the long term, given STZ's issues with corporate governance. There are several debates now with Constellation, but the result is a more attractive risk/reward and a recent margin profile for the next year with potential upside. This write-up has mostly focused on the beer business, given this is the key value driver. The W&S business is 23% of rev and 60% of EBIT FY 2022, and should get smaller over time as STZ's beer organic rev algo is plus 7 to 9% versus the W&S organic rev algo at 2 to 4%. STZ's net leverage is now 3.5x after the $1.5 billion cash payment to the Sands. The new net leverage target is 3x versus 3.5x in the past. The stock is trading at 14.7x FY24 EV EBITDA and 13.3x FY25 EV EBITDA. The company's fiscal year end is February, so in the next 3 to 6 months, the valuation focus should shift to FY25. The 13.3x is attractive relative to the company's 15.3x average over the last 5 years. Range is 14.3x to 16.4x. On a relative basis, the stock is trading at a 12% discount to beverages versus an 8% discount on average over the past 5 years. The discount has widened in recent years due to the capital allocation mishaps. In the 2015 to 2018 period, the stock traded more in line with the beverage sector. In addition to multiple expansion, there is the potential for better profitability slash EBITDA if beer segment margins can revert to the 39 to 40% range versus 38% this year and next. Risks include a more significant recession and trade down, continued poor capital allocation, more limited long-term beer growth as a landlocked business. Catalyst, improving beer consumption data, FY24 guidance. Thank you very much for tuning in. See you next